Hello fellow option traders, this is Jeff and welcome to the Netflix earnings play for April of 2015. So today is April 16th, that's the day after earnings. In this video you're going to see that I set up 1, 2, 3, 4. I did 2 double calendars. Oops. Anyway, I just sold closed price line in case you're wondering. I did 2 double calendars, a back ratio, and then an, I don't know what you call it, a diagonal calendar back ratio. I don't know what the heck that other one was called, but it's illegal for me. I can't do it in my IRA, so it doesn't really count. But effectively, did 3 different earnings plays. We're going to take a look at volatility and how that affects the actual value of these earnings plays, especially on the calendars. But as you can see, if you picked a direction on Netflix, to the bullish side was the way to go, and that is the direction that I picked on the back ratio, and the direction that I picked on half of each of the double calendars, because I did a put and a call calendar. And both of them at the same price, but with different long months for that particular strike in that contract. So you'll see as I go through the video, and then I am going to rejoin you at the end and do a short summary. So enjoy. Okay, here we are, April 15th at 11:10, almost 11:11 a.m. Market's open, as you can see, and we're looking at Netflix. Now, what I did with this was I set up several possible earnings plays. My favorites are calendars. They never work out, but in theory they always should. Then I got Taylor dropped me a message here, and I can show you here a comment on the video from April 14th. Put a comment in here and gave me an example of a possible earnings play on Apple. So I messed around with that. My only problem is I don't think that I can do this type of trade in an IRA. But we'll take a look at that. You can pause this and read through it, or just go to, I mean, if you're watching this, you're already on my YouTube channel, so go ahead and look at the comment there. But regardless, I went ahead and I guess set them up anyway. I'm not sure if this is exactly the way that Taylor is talking about, but he can let me know. Be more than happy to get any comment from him, and he does want to talk about it. Okay, so one-sided conversation for right now anyway. So back to the setup here. Okay, so we're on the Analyze tab, and we can see that the market maker move is 41 right now, $41.69. That's the move that they expect on Netflix, up or down, based on the pricing of the options, basically, which is based on risk calculations, and it's all sorts of stuff. I'm not going to be getting into how options are priced, but that's what they came up with. So if you were to do a straddle or a strangle, I think a strangle's to the same strike price, or is that a straddle? I don't know. I always get confused because I don't use them. Anyway, this would probably be the spread on it. Sorry about that. I forgot about the dehumidifier running down here in my cave. So look at the implied volatility by expiration period. So this Friday's expiration is 129%. The next week 78, and then on down the line here until we get down to, let's see, how far out are we going? To January of 17, which is down to 36%. So, 129 is approximately a little bit more than double. So I came down here and I did my price slices, and you click on this little icon here. Right now it says a $sign, but you can change it to percent, and you can see that that's a 8. Well, never mind. Let me go back here. So you change it to a $sign, and I put in here plus 40. Oops, come on. Why are you saying NA now? What the heck is going on here? $10. There we go. Probably because I didn't have a $sign. So we'll do 40. And then we can take a look at a risk profile and see what those prices are, and you can see them here too. So we see what they are in a risk profile. So let's go to Friday's expiration here, and this is a standard deviation, so you can see that the market maker move is well outside of the standard deviation. Okay? Alright, now I set up a calendar, a double calendar, with a May 15 and an April 15 expiration. So these are normal monthly expirations here on this calendar. And I set up another calendar because this Friday is normal expiration, so this coming Friday is the April 15th one. Just a regular April expiration. And I set up another one for June because I wanted to get out. I didn't want to get hit so bad with volatility collapse. I know it's going to happen on the short strike, which I would be very pleased to have happen. But the long strike, I didn't want it to get hit so bad. So if I look at May, that's 52%. But if I go out to June, then it's 42%. It's going to cost a little bit more, but that's okay. All right, so I have a double calendar with April, May, and a double calendar with April, June. Then I went back down here to what Taylor was talking about, which is the back ratio. And I can't get the numbers to work out exactly the way that he was talking about to balance this out so there'd be minimal loss. So actually on this particular trade, when we look at it, we'll have like a $20,000 or $2,000 max loss. But if it moves up to the market maker move, it could be incredibly profitable. But the problem is, and let me show you here. Now, it will let me do that. Okay, so the max loss is 2,563. So I'm just gonna let's see if yeah. So that's this is the max loss basically is what I'm paying for it. We'll take a look at the risk graph on each one of those, and then I did one back ratio that I cannot do this trade because I have different expirations for my short and my long. So it looks at this short as being too risky. I can't do it. I can't sell a naked call. So it won't let me do it even when I combine these two together. So that's trade. Also, I wanted my long to be a little bit, this is going to be about the same price effectively as this one here, the same max loss. We'll take a look at that. So those are the trades that we're going to take a peek at. All right, so it's 11:18, so I'm going to unlock each and every one of these and have the prices as of today at the making of this video, just so we're totally fair about this, and you can reconstruct these yourself just based on these prices here, as long as you do it this week before this April expiration here. We'll take a look at each one. So the first double calendar is right here, and here are the market maker moves out here, right here, and right here. So the question here is, this whole tends to collapse. If the price doesn't move, this red line is going to drop below here. So it's going to end up being a loss. So this looks very profitable. I mean, if it makes a market maker move out here to $514, that is $1,847 profit. If it moves down to the market maker move on the downside, that's $1,733 profit off of $500, or actually there's $1,000 risk here. So if things go really bad, you could lose $1,000 on this particular trade. Now I can mess around by clicking on the little cog wheel here. I can mess around with these IV prices and look into the future. For instance, if I take this April thing and say, well, I want to do a minus, let's see, where are we at? 132, so it would be minus 60, right? Minus 60 in IV to get close to what we have for, so April, we're now close to what we have for May. So April, we're now at 72, which is probably more normal. All these now are at 72. So our white line, as of today's date, our white line, if that should, that IV collapses that far, anywhere in this range here, we're going to make a crap load of money. I've done these kind of videos before, but this time we're going to actually have these simulated trades set up here. We're going to take a look at them after the market closes this afternoon, and then we'll take a look tomorrow, and then I'll piece all three of these together into one magnificent earnings play video. Even more magnificent than the ones before it. But I can tell you from experience that this red line is going to collapse too. So if we take the May one, and we're going to say say minus 10 on that. So look what happens. Now you can see how easy it is for this sag here in the middle. If you happen to be in the middle, if the price doesn't move, you might make a couple of bucks off of it, but it's not going to be anything real exciting. Your max profit, if you move to the market maker move point, here would be down to $1,000, down to approximately $1,000. Still not too bad if it does move there. But my experience again has been is that this thing just collapses so bad, and I've never really quantified from an IV perspective how much it does collapse. So I wanted to just take a look here and actually look at all these different trades and see how they do work out. So you can see how you can sort of look into the future and see what the heck is going to happen. Would I want to do another calendar in the middle here? Maybe I want to, but let's just take a look at these and see how they work out. All right. When earnings season comes around, for me, I get bored because I can't trade. I don't want to trade anything during earnings season, so I tend to stand on the sidelines, and I dream about making thousands of dollars on an earnings play. You should just like buy a call or buy a put. Well, you don't want to do that because IV is going to collapse, and it's going to be, unless it's deep in the money, it's going to be you're just going to be blowing all this money for nothing. And a way to look at that is to say, let's buy a May, and say you think it's going to go up $40. So even if you buy in at the money, that's $3,000. And if it goes down, you're going to lose your $3,000. So I don't know. You want to take that kind of risk? I don't know if I would. I know that IV here is 53, but I don't know how that's going to change, or how those prices are going to change. All right, so the next trade that I want to take a look at, uncheck these and check this. This is cost about twice as much because we're buying a June call that is it's out of the money, but still it's pretty pricey. And the same thing with this put is also out of the money, but still pricey nonetheless. And that's the big contribution to the cost of this. Pretty much the same thing here with this. We have the same strikes at 525 and 435, but we have this June expiration. So will it hold better? I don't know. We'll have to see. And then I have this back ratio trade, which if we move up, and this is on the call side, so we're placing a bet in direction here on Netflix earnings. So we're saying that, yeah, you know what, if it moves up here, we'll make $2,420. But if it moves in the other direction, then we lose $1,422. So we're paying $2,000 for this, and we could lose almost all of it if it moves in the wrong direction. And then you got IV collapse too to deal with. Then I thought, well, what if we did something that had different expirations? Let's say we sold the April 15 470 and bought some 490 calls, which are way up here, in a month out, which is going to cost a hefty amount of money. So we're talking $2,200 a piece for those, but we're getting $2,400 in credit. I can't do this trade in an IRA. I am sorry to say. And let's see here. Let me just highlight this. What is this box for here? I don't know what this is for. Okay, I can't highlight it the way that I want it to. So, this is the trade here. If we move down the $40, then we're going to end up losing a tad bit of money here. This is as of for today, but our max could be $11.94 depending on how quickly we can get out of it tomorrow. But our max gain could be, and I don't know how much this will change either, but our max gain could be $15.55 or so. So we unlocked and relocked all these prices. We're ready to rock and roll. Let's see what happens after market. I'll probably be back about 4:30 or so. All right. See you later. Well, okay, here we are at 5:05 p.m. in the afternoon, Eastern Time. Netflix earnings announcement was, let's see here if it posted it yet or not. Oops. Let's see here. 67.4 cents per share. Actual was 77. So everybody's happy. We had a move from 476 to a high of 542. All right, so jumping over to the Analyze tab now. This is after hours, so you know it doesn't really matter a whole heck of a lot. So we're at 5 right now. We're at 532. So we're at 532. Here's the line right here. Here's our double calendar. This is the May-April double calendar. This is just for fun tonight because things are going to change tomorrow. This is the April-June double calendar. Alright, let's take a look at this back ratio here. Back ratio is doing very, very well. Of course, there's risk here. There's a couple $1,000s in risk. But it actually did pretty good. So this was this is $2,000 in risk right here. It's doing very well. We'll see what volatility does to it tomorrow after the market opens. And then there's the other trade, which is the back ratio that Taylor was talking about, I think. And this also, of course, we took a bet to the upside on both of these back ratios here. It's a back ratio with a different expiration. So I can do this one in my IRA because, like I mentioned, they're both the same expiration, but when they're different expirations, then I guess they don't like that. So they don't consider this long calls a cover for this short call, so they don't allow me to do it. But if you have just a regular margin account and you have enough money in it, you can do this particular trade right here. So yeah, they're all looking pretty good with the upside bets, but the secret will be tomorrow with the calendars, and take a look at what those are going to look like in the morning. So what we would do, if we're looking pretty successful, we would go ahead and close this calendar down here, the put calendar, which is this one right here. We would close this one and then ride this other one, and then figure out if we want to, if it's going to go even higher. We could buy back the short and ride the long. Who knows? Just a lot of options on these options contracts that we can do. All right, so it's going to be interesting to see what's going to happen tomorrow. See you then. Okay, it's now 9:46 a.m. Eastern Time. The market is open. Everything's trading. Netflix is up $12.70. Or no, percent. It's up $60. Unbelievable. Just unbelievable. Okay, so if we were just to close everything out right now, we'd be up 5,500 and whatever. So that would be a beautiful thing. So of interest to me, first off, though, is the first two original calendars, which are these two here. And this is the April-May calendar. So now if I was to close the put calendar, so we'll say analyze opposite trade, and we'll get rid of that put calendar, and that is going to cost us, it's going to, we can sell it for 45 cents after we paid $5.83 for it. So I lock that in now for now, because I'm going to do the math later after the video, and I'll include a spreadsheet with all this stuff in it so we can compare things. So in theory, if we just would have gone with this particular calendar here, which is the call calendar, that's all that's left up there right now, I do believe, we'd only end up with 55 cents. So you can see here, I have a grandson down here that's goofing around. Look what happened to this double calendar. It got beat up pretty bad by this IV collapse. So the April's down to 66, so it lost half of its IV, and I forget what this June, or not the June, but let's go up here. The apparently the May's also lost about 20 points, it looks like, if I remember right there, around 50. So now we're down to 43. And the puts are very high up there, so I would think that if I was to, I don't know what I would do here. I'm going to have to take a look at these prices on these individual options too. I'm not sure that I'm going to have enough time to do that today. It's just bad timing because we got plenty of trades we can do this on next week too. But selling this calendar for a loss, a huge loss, and then only making $50 on this one is not a good thing. So let's uncheck these two and let's take a look at June calendar. Here's the June calendar. Looks like it fared a little bit better. Overall, up $445 overall. So now if we wanted to get rid of the put side of this, which is down here. Wait, it's here. That's call. Here's the put. We would say analyze opposite trade. And then we would just have this calendar here, which probably would have been a pretty good deal to go with. Definitely one. It's going to cost you a little bit more. But I would think if you want to use calendars on earnings, just pick a direction. Look at the market maker move. Put your strike right around the market maker move, which is what we did here. And actually the move was a little bit bigger, but that's okay. You would have spent almost $10 to buy it, but it would be paying off handsomely with it would have cost you $1,000 to buy it, and you would have made $1,000. So that would be 100% gain. That would be a nice thing as well. All right, so let's take a look now at, uncheck this one here. Sorry about the background noise, but I'm sure you understand. Here's the back ratio. The back ratio would have cost $2,000, and we would have made, we're up about $4,000 on this one. That is pretty. You know what, Taylor? I think this is a pretty good deal, even though the risk was pretty high on this. I don't know what would have happened. Well, if it would have moved down, and what was our down? 498. Still would have only lost, if we were to get out of it now, in theory, say at 490, we would have lost $700 on it. If it would have been around 496 or something like that, only would have been a couple hundred, and if it, of course, would not have done anything, it wouldn't have cost us anything. So pick a direction is, really all that I have to say. So if we were to close this right now, let's just do a analyze opposite trade, unlock it. That is now worth 58. Well, it flies around a lot, doesn't it? $59.15. So we would have paid $20 for it, and we'd be able to sell it for $60. That's almost a $4,000 gain. That's not bad at all. All right, and then the other back ratio, which is I don't really call this is a back, a back calendar ratio, possibly. Where did that go here? That's this one right here. That one would be up only 1,600. Do I have the right thing here? Yeah, because we picked different expiration months. April for the short call, and then we picked May for out of the money call, and we did 2 of those. So our risk here was around $2,000, about the same as the regular back ratio, but we would not have made very much money out of it at this point. Even though, you really could say here that, how much would it cost to buy this one back? Oh, it costs $7,000 to buy that one back. But you'd be not that much up. So you may want to, for instance, if you think it's going to march even higher, you could, just hang on to these two longs here, which is what effectively we have left here, and hope that they march up. But I'm much more in favor of just taking the money off the table. So the best one was just this simple back ratio, and that is the big money maker on this earnings. In second place might be this calendar. Yeah, maybe not all that much. All right, so after the interruption, I sort of got lost to where I was, but as far as who is in what place here, the back ratio, definitely pick a direction, do the back ratio, and maybe next time we'll do more various back ratios, like maybe not picks, deeper in the money and deeper and further out of the money for the next earnings play. Simulation, I guess you might say. Okay, so that is it for this video, for the recap for today. I'd like to see, I'm going to stay in this particular trade here for a little while and see how it works out. We don't have anything else. I'm just checking to see if anything else is checked here. No. So I'm going to stay in here. See, it's already like sinking back a little bit, I guess. Maybe it's pulling back. I'm not sure. We did, though. I need to see, did I buy back? I can't break this up like that, so I have to just close this thing out. So I would have closed it out for $60 after paying $20 for it, so would have been very happy with that. All right, so that's it. Might attach a recap to the end of this, maybe show that spreadsheet. I'll have to put that together, though. All right, have a great day. All right, so here we are. It's about 3:34 in the afternoon. I'm going to wrap this video up. You can see that Netflix continued to climb throughout the day on this 30-minute chart here. At a pretty kick-butt day is like all I have to say. So let's go take a look at the Analyze tab. Right now, here's what I did. This is the way that I left it. All the calendars in the back ratio are active right now, have check marks in them, along with I closed the two put calendars for a rather significant, well, let's see here, I think I need to uncheck that one, for a pretty significant loss on each of them. I don't think this one's really 40, but that's okay. I think it was probably better than that this morning, but I forgot to unlock it this morning. And so I closed those and kept everything else. This back ratio that has different expiration periods, which is the one that I mentioned that I can't do. I probably said that 10 times in this video now. So I can't do that in my IRA, so we're not even counting that one. So now that we've hung on to this throughout the day, we're at about $6,000 in profit. And I can tell you right now that I would get out of here. All right, and that's the way it looks right now. You can, do these trades yourself. You can go to Think Back and do them next week if you want, however you want to do it. But this is the way that it ended up. We had quite a bit of risk out here, $4,000 in risk, and we ended up with $6,000 in credit. But like I said this morning, I probably would have bailed on these two calendars, also on the both call calendars, just to get out, and I would have rode the back ratio, which I didn't. Here's the sell here, but I didn't do it this morning. So right now this back ratio is worth $8,500. So that's what I would have done. That's what I would have done this morning. And this is in hindsight 2020 either. That's what I would have done. I would have gotten out of all the calendars, this morning and just hung on to this back ratio, and I would get out of that now. And I'm not sure exactly, how that would look. So we shouldn't have that left. So anyway, would have ended up profitable though, very profitable. Okay, so let's jump over to the spreadsheet. And this spreadsheet, I'm going to, this is my regular weekly tracking sheet here. So this will be posted up on my blog on the downloads page. So here's something that we can look at. This is what I meant by, I wanted to see how these compare. This is IV on the day of earnings. This is the day that I actually opened these simulated trades. And we can see that the May IV went from 52 to 36, and the April, which is the expiration tomorrow, went from 132 to 48, rounded off. Now, since this was the short one, collapsing IV is great, because then, in theory, you can buy that back really cheap. But also, IV on your long dropped more than I had expected it to drop. I was a little bit surprised at that amount of drop, and so that's why the calendars don't really work out. Even if you pick a direction, say you were bullish and you picked only the call calendars, you might have made a little bit, but probably not too much. And the same thing goes for, you can see on the put side, we went from 53 to 41 and 132 to 83. This one, this is not the back ratio that I ended up with, so this is only a screenshot that I had from back then, so I didn't bother counting that one. If we went and looked at the April-June calendars, you can see that the June held up a little bit better, but not enough to justify the additional expense in my mind, because it went from 41 to 34, and here we went from 52 to 36. So it was a little bit better. I was hoping that the IV would hang on just at, somewhat, maybe like around 38 or something like that, but not to be. And of course, the April is the same, like the 132 to 47. And same thing on the put side, 44 to 39. That held up a little bit better, but price moved so far away from it, there wasn't much of a chance or a change in IV because of that. So on the put side, it was a little bit more stable as far as collapse and implied volatility, but not much. So those are the numbers for you. I'll try to get the spreadsheet up while this video is rendering. So I hope you enjoyed this little excursion into the Netflix earnings. What I wanted to do really was to see how much IV collapse are we really talking about. And there it is, in green and gold. Oh, those are Packer colors. Oh, I'm sorry. That's what I bleed, is green and gold blood. I want you to know that. Okay, so anyway, yeah, that's it. I hope this was of some value to me. It certainly, or to you, because I was going to say it was definitely of value to me. So thanks for watching. Have a great day, and happy trading.